Okay, let's dive into this. Welcome to This Explainer. Today we're tackling one of the most tempting, magnetic, and quite frankly, dangerous traps in the entire digital asset space. We're looking at the illusion of high APY. Everyone wants their money to work for them, right? But understanding the mechanics behind the numbers you're seeing is the difference between actually growing your portfolio and literally losing it all. So I want you to imagine this. You're scrolling through forums, researching new platforms, and boom, you find a project promising 50% or maybe even a staggering 100% APY on your crypto. Just pause and think about that for a second. It sounds like the absolute ultimate passive income stream, doesn't it? It grabs your attention right away. In a world where traditional finance gives you, single-digit returns on a good day, seeing a 3-digit percentage next to your favorite asset feels like you stumbled onto a secret gold mine. And the math playing in your head goes a little something exactly like this. You invest $1,000 today, you step back, do absolutely nothing, and walk away with $2,000 exactly 1 year from now. It's that tantalizing, intoxicating, get-rich-quick dream. The whole appeal of effortless wealth multiplication is this incredibly powerful psychological hook, and trust me, platform developers know exactly how to use it to reel you in. But here is the stark contrast and the really harsh reality of chasing those insane numbers. In 9 out of 10 cases, instead of doubling your money and walking away rich, you end up with a big, fat zero in your portfolio. Your initial investment just vanishes. So how does this actually happen? Well, the big players in this space use complex financial jargon and hidden mechanics to create a master illusion. You aren't just making a bad trade, you're participating in a system that's designed to look like a win while pretty much guaranteeing a loss. Section 1. The difference, APY versus APR. Now, what's really interesting here is that to understand how we get fooled, we have to look at where the smoke and mirrors begin. This is the very foundation of how retail investors are misled. Let's break this down plainly so you can spot it immediately next time. First, we have APY, which stands for annual percentage yield. The secret ingredient here is compound interest. APY assumes that the profit you make is automatically reinvested, sometimes daily or even weekly, so your interest is constantly earning its own interest, mathematically accelerating your returns into this massive snowball effect. Then we have APR, or annual percentage rate, which is a lot simpler. It does not include that compounding effect at all. Shady platforms absolutely love to flash massive APY numbers because that compounding math makes the potential returns look incredibly astronomical over a year, even if the base rate is completely unsustainable. Section 2. The crypto inflation trap. Okay, so that raises a pretty logical question. How do these platforms actually pay out those astronomical percentages in the first place? Where is that money even coming from? We call this the inflation trap. Imagine a project promises you 100% APY, but they pay out that yield not in Bitcoin, not in Ethereum, but in their own highly obscure, newly created native token. To pay you that 100% return, they aren't generating any real-world value or network fees or revenue. No, they literally just print new tokens out of thin air to hand out to you. Over the course of a year, to keep up with those high yields for everybody, they're constantly printing, effectively doubling the total market supply of that token. So yes, technically you're earning double the tokens, but you're holding a massively inflated and diluted asset. So the crucial point is this. When the supply of any asset artificially doubles without any organic new demand to match it, the underlying value crashes. It just has to. Often, the price drops by 90% or even more. The project technically fulfilled its promise, right? It gave you your 100% APY, meaning you physically hold twice as many tokens in your wallet. But because the price plummeted by 90%, your overall investment is essentially worth mere pennies. You've been mathematically diluted into a massive loss, all while the interface was cheerfully telling you that you were making a profit. Section 3. 3 legitimate strategies. All right, enough about the traps and the scams. Let's shift gears completely and look at the officially sound, reliable methods for earning passive yield without falling straight into an inflation trap. So what do realistic expectations actually look like in a healthy market? Well, the first strategy is proof-of-stake staking. Here, you're directly supporting the security of major networks. For Ethereum, you're looking at around 3.5%. Solana might be 6 to 7%, and Cosmos or Atom hovers around 12 to 15%. Notice how these percentages are a bit lower, but they're incredibly stable because they're built right into the network's core function. Strategy number 2, stablecoins. Using established platforms like Nexo with stable assets like USD or USDC can yield up to 12 to 16%. This is arguably one of the safest routes because stablecoins are pegged to fiat money, meaning they carry virtually zero price crash risk compared to those highly volatile tokens. Finally, liquidity providing on major DeFi platforms like Uniswap, where you earn between 3% and 8% APY. And crucially, that yield comes from actual transaction fees paid by real users trading those pairs, not from freshly printed tokens. When you compare these realistic numbers to those fake 100% promises, the reality of sustainable yield becomes incredibly clear. Section 4. Red flags for safety. Now that we know what legitimate yield looks like, let's move forward and see how this builds our defensive framework. Because protecting your principal investment is rule number 1. Here are the absolute most critical red flags you need to watch out for. You should heavily scrutinize any platform showing these traits. First up, if you see yields over 20 to 30% on stable markets, step back. Real, organic yields simply do not go that high sustainably without some massive hidden risks. Second, beware of new DeFi projects with zero smart contract audits. If the underlying code hasn't been verified by a reputable third-party security firm, you're at an extremely high risk of a rug pull. That's where the developers leave a backdoor in the code, drain all the investor funds in the middle of the night, and just vanish entirely. And third, watch out for platforms that enforce locked periods without any withdrawal rights. If a project demands you lock your funds up for months and removes your ability to pull your money out if the market turns, yeah, that is a massive, glaring warning sign. Which brings us to a quote that perfectly summarizes our core thesis for this explainer today. Better a safe 6% in a verified asset than a 500% scam in a project that won't exist tomorrow. The entire goal of passive income is to steadily grow your wealth over time. It is not to gamble your hard-earned principal on insane percentages that are mathematically designed to dilute your money into oblivion. Keep this rule in your head every single time you're evaluating a new yield platform. So, armed with the knowledge of how APY compounding really works, the obvious dangers of the inflation trap, and the defensive red flags to watch for, I want to leave you with this final provocative question. Where do you keep your crypto for passive income? Take a really hard look at your current portfolio strategy right now. Are you unknowingly chasing a 100% illusion, or are you utilizing stable, verified networks to build solid, sustainable yield? Stay safe out there, keep your focus on the actual mechanics over the flashy numbers, and let this explainer guide your next intelligent move in the markets. Keep learning and keep those assets protected.